and then screen. Okay. Okay. Thank you guys for coming. Yet another day. The university is surviving, so hopefully enough of us can stay healthy that we can keep the doors open for a few more weeks. But I appreciate you being here. I know at this lousy hour, it was not my idea to have this class at 5 o'clock, but it is what it is. Okay, so we are now in the third day of the semester. We're going to move into our second topic on the money supply process. I plan on going through this one pretty methodically over the next 3 class periods, and hopefully we'll have enough time in there to work some problems together and have you guys work some problems on your own that will help kind of prepare you for what you might see on a lab assignment or a future exam. All right, so you guys might recall from your intermediate macro classes, which in the last class you indicated to me that you all have already had that class, or maybe you're taking it concurrently. Maybe you remember from those intermediate macro classes that movements in the economy's money supply affect a lot of really important variables in the macro economy. Just to name a few, things like interest rates, inflation, GDP, other kind of broader measures of economic activity are influenced by what the money supply is in our economy. And so the money supply really has far-reaching effects on the overall economy. And so it's going to be important, in my opinion, to understand 3 things over the next few class periods. And one is, how is the money supply actually determined? What are the forces in the economy that determine what the overall money supply is? 2, who controls the money supply? Or maybe that's too strong of a word. Maybe I should say, who is it that's responsible for trying to manage the supply of money? Indicating that the money supply is probably not something that is perfectly controllable by any one person or institution. What causes the money supply to change over time? What causes it to grow or to shrink? In this second section of the course, we're going to attempt to answer these questions and a number of others by providing a real detailed description of this thing called the money supply process. Okay, now what do I mean by the money supply process? Just think of this as the mechanism or the set of mechanisms in our economy that determine what the level of the money supply is. One of the important components of the money supply, for example, is how much currency is in circulation. So what are the mechanisms that are responsible for determining those things? That's what we mean by the money supply process. Our investigation of this is going to proceed in 3 steps, okay, which I've kind of outlined here as these learning objectives. In step 1, which is really all we're going to be able to cover today, is we want to establish a link between 2 really important concepts that you might not be at all familiar with. One is this thing called the Federal Reserve's balance sheet, and specifically how the Fed's balance sheet is linked to this concept called the monetary base. Now, just to be clear up front, the monetary base is not the same thing as the money supply. Those 2 concepts are linked together in a particular way through this money supply process, which we'll elaborate on, but they're different concepts. Step 2, we want to show how the money supply, which again is linked to the monetary base, can go up or down through a process called multiple deposit creation. Or the money supply could go down through multiple deposit contraction, right? You guys may have seen this concept of the deposit multiplier in your intermediate macro class, or even perhaps your macro principles class. I actually do talk about this in macro principles to some extent, but we'll get into it in much more detail in this class. The last step that we will look at is to explain how the actions of the private sector, in particular, the actions of banks, as well as the non-bank public, so like businesses and individual households, affect the total money supply. Turns out that the central bank, the Federal Reserve, does not have perfect control of the money supply. And the reason why it doesn't is because there are these two other actors in the economy, banks as well as individual consumers, whose behavior has a big effect on the money supply. When economic circumstances change, that causes our behavior to change in such a way that can have dramatically different effects on the money supply. That's why controlling the money supply or managing the money supply is such a difficult task for the central bank. It's so difficult, in fact, that most modern central banks have more or less abandoned any kind of tight control over the money supply altogether. One other point I want to make before we open up into the rest of the slides here is let me elaborate just a little bit on this connection between banks and the money supply. One of the biggest components of the money supply are things like your checking account balances that you have with banks. Banking behavior obviously is going to have a big impact then on the creation of those bank deposits throughout the economy. So the way banks behave through this process of multiple deposit expansion, where they take in deposits from customers and then loan out some of those assets to other investors, is going to have a big effect on the money supply. Okay, that's the key way in which banks, separate from the Federal Reserve, can influence the supply of money in the economy. This section of the course is going to provide a real detailed overview of all those linkages. Today, though, we'll just try to get through the first objective, that is explaining this connection between the Fed's balance sheet and the monetary base. What are those two concepts to begin with, and how are they connected? Okay, before we get into that, I want to take a step back and just make sure that everybody is kind of on the same playing field here when it comes to understanding what the money supply is. All right. The way the money supply is typically measured in a modern economy is through these concepts called monetary aggregates. Okay. These monetary aggregates are measures of the quantity of money that are going to be broader than just the currency that some of us use. Monetary aggregates are really just a way of kind of summing up the total value of all of those different types of assets that we use to purchase goods and services, or all of those different assets that comprise our economy's medium of exchange. That's what we mean by a monetary aggregate. But therein lies the problem with that definition, or the difficulty, right? In the real world, you guys use probably a lot of different assets to purchase goods and services with, not just any single asset. And so this makes it somewhat difficult to actually define what the money supply is. It depends on what assets you actually want to include in your measure of the money supply. Now, what are some obvious assets that should be part of our nation's supply of money? Well, clearly, things like currency and coins are used as a medium of exchange. The total value of all of those assets is part of the money supply. But of course, that's not the only thing you guys use to purchase goods and services with, right? I would say that most of you all are like me. You probably use like a debit card, which is linked to your checking account balance at a bank. That's an asset that is separate from currency and coin, but because we can use it readily to conduct transactions with, we will want to include it in our measure of the money supply, or a monetary aggregate. There are more. There's other types of digital currencies, all right? There's even other assets that are slightly less liquid than the ones that I just mentioned. What does that word mean, by the way? I don't think I have that in the slides. When we refer to the liquidity of an asset, what are we talking about there? If an asset is highly liquid, what does that mean in economics? Yeah, back row. Yeah, an asset is highly liquid if it's quickly and kind of costlessly convertible into the economy's medium of exchange. So like cash or currency is perfectly liquid. It's an asset that is already in the form of the economy's medium of exchange, right? My house is a highly illiquid asset. I can't just transform it into money quickly. I suppose I could, but I would incur a huge transactions cost, right? In fact, I guarantee you that I could sell my house to any number of you right now if I sold it for like $100, right? You would be willing to buy it because you could turn around and sell it for a lot more than that. But I would incur this massive transactions cost in converting my home to cash. And so it's a highly illiquid asset, right? Measures of the money supply can differ depending on the relative liquidity of the assets inside that measure. There are two monetary aggregates that you've probably seen these before, but I want to make sure everybody remembers them from their intermediate and principles classes. The US government is really creative about how they name these things. It's called M1 and M2, okay? M1 is a narrow definition of the money supply. This is really the concept of the money supply that I want you guys to think about as we move through this discussion of the money supply process. It basically contains two types of assets that you need to be aware of. One is all the currency and coin in circulation, right? The other, and more important, are our checking account balances, deposits that we've made at commercial banks that banks have to provide back to us on demand, right? We can use these checking account balances to purchase items with by either writing a check or swiping a debit card, right? So they are part of the M1 money supply. It's a narrow definition of money in the sense that all of the assets in M1 are perfectly liquid. They're already in the form of the economy's medium of exchange. Here's some data. As of July of this year, the M1 money supply in the US is about $5.3 trillion with a T. And you can see from the pie chart what is by far the biggest component of the M1 money supply. It's not currency, it's the electronic funds that we have available in our checking account balances. That makes up a good 2/3 of the total M1 money supply, or about $3.5 trillion as of July of this year. I don't think the August data is available yet. The currency component of M1 is much smaller. And by the way, a good portion of this currency is actually held by people outside of the United States. So this $1.9 trillion, we don't have 1.9 trillion US dollars floating around within the geographic confines of the United States. A great portion of this, I'm not sure exactly how much, is actually held by people in other countries and other central banks. For example, Venezuela is going through this hyperinflation that they can't seem to escape. And a lot of transactions are conducted with US dollars down there instead of Venezuelan bolivars because they don't retain their value. The M2 money supply is a broader measure of money whose assets are somewhat less liquid than those in M1. Now, what is M2 composed of? First of all, M2 has all of M1 in it. So M2 swallows up M1. If an asset is in M1, it's also in M2. But M2 consists of some other things, mainly these small time deposits, retail time deposits worth less than $100,000 each. Those are bank certificates of deposits mainly. Savings accounts, which are different than your checking accounts. Most people can't write checks against their savings accounts. Money market deposit accounts, some of you may have, or your parents may have those, as well as non-institutional money market funds. You know what that means? What does non-institutional money market funds mean? Those are retail level money market mutual funds, as opposed to funds that are held by institutions like insurance companies or other corporations, right? Or maybe some government institution. So retail level money market mutual funds or non-institutional are part of the M2 money supply. These are, I don't know if you guys know this, but these are assets that you can purchase. For instance, it's like buying shares of a particular mutual fund. The mutual fund then turns around and invests in other highly liquid products, and you earn a return on those assets, but it also enables you to write a certain number of checks against those assets per month or per quarter, but not an unlimited amount. And you have to have a certain amount to even to set up an account in the first place. And so they're not quite as liquid as currency or checking account balances. Once we broaden this definition of the money supply, though, to contain these other assets, we see that the money supply is huge. In the US, it's about $18.5 trillion. That's why it's so difficult to measure the money supply, because once you start considering slightly less liquid assets, the measure of the money supply gets a lot bigger, right? Your savings account balances are part of M2. Well, you can't technically spend those, but it's pretty easy to transform savings account balances into checking account balances, right? You just hit a button on the website or on the phone app, and it moves it over to your checking account. And so because of that, it's probably a good idea to include our savings account balances in our measure of the money supply, but it's somewhat broader than M1. The biggest component of M2, by the way, is not even M1. It's the total value of our savings account balances is about close to 2/3 of the total value of M2. Okay, you guys have questions about that? Hopefully, that may have been in more detail than you saw in your intermediate or principles class, but you want to definitely understand the differences between M1 and M2. The model or the story of the money supply process that we're going to develop over the next 3 classes really focuses more on M1. The 2 main monetary assets that we want to think about here is currency in circulation and checkable deposits at banks. That's really what we're focusing on here. Okay, questions so far? Don't be afraid to raise your hand and tell me to slow down or clarify something. I have no problem doing that. Okay, we're going to begin now our kind of investigation of the money supply process by describing the monetary base and showing how it is linked to the Fed's balance sheet. Now, anytime you develop a model in an economics class, it's important that you guys understand all the different characters or agents in the model and how they kind of interact with one another. Now that may sound a little esoteric, but go back to your principles class for a minute. You guys studied basic supply and demand, right? Well, what were you modeling there? You were modeling the behavior of sellers. That describes the supply side of the market. And you were modeling the behavior of buyers. That describes the demand side of the market. Buyers and sellers interact with each other. And what happens in equilibrium? Prices and quantities are determined. So even in a simple supply and demand model, you have buyers and you have sellers, and you have them interacting with one another. Our model of the money supply process also has a cast of characters that behave in certain ways. So let me talk about who that cast of characters is and what exactly they do in this model. First off, the most important one, I think, of course, is the central bank or the Federal Reserve. That's the institution, that's the character in our model that is going to be responsible for trying to manage the money supply and, of course, regulate the banking system. They're going to play a key role in the money supply process. But that's not the only character. What's another one? Is the private banking system. The banking system is critically important. As we saw from the data on M1, bank checking accounts are the biggest component of the M1 money supply. So the way private banks behave, the decisions they make about how much to keep in reserve versus how much to loan out to investors is going to play a key role in determining the money supply. What's the third character in our model? It's going to be the non-bank public. That's you and me, and business and non-bank businesses and firms. Our actions are also going to affect the money supply. And in what way? All of us, whether you realize this consciously or not, make portfolio decisions every period, in the sense that you have to decide how much of your money you want to hold in cash or currency versus how much you want to keep in your checking account. That portfolio decision is going to have an impact on the total money supply process. So the non-bank public, the banking system, as well as the Federal Reserve in concert, all are going to help determine the level of the money supply in our economy. Okay, questions so far? Those are the three characters. Now, how is the money supply process, as described by these characters in our model, linked to one another? Figure 2.1a gives a nice visual description, I think, of the money supply process. I think, in fact, it's really the most important picture in the slides, because if you really understand what's in this picture, I think you'll have a pretty deep understanding of the money supply process. What it shows, on the right-hand side in this green square, we have an economy's total supply of money. The diagram here shows that the total supply of money is equal to the product of two things. One of them is this concept called the monetary base, and the other is this different concept called the money multiplier. Beneath each of these squares shows the characters in our model that influence that variable or concept. So here I'm arguing essentially that the monetary base is basically perfectly controlled by the Federal Reserve. The Federal Reserve, through its actions regarding its balance sheet, can move the monetary base up or down at will. And we'll talk specifically about how that's done today and go through some actual numerical examples. The money multiplier, which we won't talk about until the next class, however, is affected by all three characters: the Fed, the banking system, as well as the non-bank public. All right, so changes in their behavior can, of course, affect the total supply of money. Let me start with the monetary base. So let's be really clear about what the heck this concept is, because it's not the same thing as the money supply. It's linked to the money supply, but it's actually different. The monetary base, in some textbooks and in news articles, it's oftentimes referred to as high-powered money. I don't want you to get confused there. When you see this term, that's the same thing as the monetary base. High-powered money, monetary base. I'm going to refer to it as base money in this class. Monetary base has a simple definition. It's equal to currency in circulation plus reserve balances in the private banking sector. Now, we all know what currency in circulation is. Let's again be clear. What are reserve balances? So these are the fraction of bank deposits that banks have elected to hold in reserve as opposed to loaning out or investing in other products, right? Jameson, right, that's your name. If you go and deposit $1 into your checking account, if the bank decides to loan out 80 cents of it and keep 20 cents in reserve, then that's what that 20 cents refers to. They're increasing their reserve balances there by 20 cents and increasing their investments by another 80 cents. Okay. The money multiplier is the concept that actually links the monetary base to the overall supply of money, which I'll get into much more detail in the next class. Now, let's just, assuming for the sake of argument for right now, that the money multiplier was a really stable concept. It was just some number that always stayed fixed forever. Then what does this simple equation tell us? It tells us that the Fed could control the money supply perfectly simply by adjusting the monetary base, right? For example, if the money multiplier was equal to 2, then if the Fed wanted to increase the money supply by $2, all it would need to do would be to increase the monetary base by $1. So if the money multiplier is really stable and predictable, the model would suggest that the Fed can kind of tightly control the money supply. That's a really dubious assumption, though. Okay, it turns out that in the real world, the money multiplier is highly unstable. And I'm actually going to show you some data in not the next class, but the one after that, that shows how the money multiplier has changed dramatically just over the past 10 years or so. During the financial crisis, it collapsed, and it's wiggled around a lot during the most recent COVID-19 recession. And so if the money multiplier is volatile and unpredictable, that tells us then that the Fed is not going to be able to tightly control the money supply by adjusting the monetary base, because it can't predict perfectly what the money multiplier is going to be. And why is that? Because the Fed can't perfectly predict or forecast how the banking system and the non-bank public is going to change its behavior as economic conditions change. We go into a recession or into an expansion, and banks and the private sector start to behave a lot differently regarding their money decisions. And so the Fed can't perfectly control the money supply in that way because the money multiplier isn't 100% stable. All right, nonetheless, if the Fed were to try to manage the money supply in any way, what this equation shows you is that it really has to work through changes in the monetary base. And that's what I want to get into most today, is talking about how the Fed actually adjusts the monetary base by making changes to its balance sheet. What I'm going to do on the next couple of slides. So these are the Fed's balance sheet, and let me just say this up front, is a really important concept that I want you guys to understand. So we're going to kind of go through it slowly to make sure you all know what each of these entries mean. The way monetary policy is conducted today is it's implemented effectively through changes in the Federal Reserve's balance sheet, through expansions and contractions of the balance sheet. So how the Fed actually goes about accomplishing that is really important. And as a first step, you really need to understand what the heck we're even talking about when we refer to the Federal Reserve's balance sheet. So let's go through that. If you guys have had any accounting, you'll kind of know what a balance sheet is, hopefully. I actually have never had an accounting class, but I do know that balance sheets have assets on one side and liabilities or debts or obligations on the other side, right? And the idea with a balance sheet is that they're supposed to balance, right? The sum of the assets should be equal to the sum of the liability. And when something happens to the asset side of the balance sheet, there should be a corresponding change on the liability side, okay? So let's go through the Fed's balance sheet item by item here. Now, I should say that this is actually a condensed version of the Fed's real balance sheet. If you want to see what it really looks like, follow this link here, and it will show you all the different items. I've actually only picked out the ones that are really the most important for understanding how monetary policy works. All those other ones are in the last category down here. Okay, let's start with the asset side of the Fed's balance sheet first. In most years, the most important assets on the asset side of the Fed's balance sheet are going to be two things: the Fed's holdings of US Treasury Securities and also the discount loans that it's made to banks. So as of, let's see, August 13th of this year, the Fed has, these are in millions of dollars, so that's $4.3 trillion worth of US Treasury security. Now, what are U.S. Treasury securities? These are Treasury bills, notes, and bonds. That means essentially Treasury bonds of all different maturity. Short maturity debt all the way out to long maturity debt, like the 30-year Treasury bond. In reality, the Fed holds lots of 10-year Treasury notes as well as 3-month Treasury bills. That's the major portion of the U.S. Treasury securities. The Fed owns $4.3 trillion worth of that stuff. It makes interest off those securities, which is how the Fed makes a profit. Discount loans to banks are currently close to $3 billion, so not anywhere near the size of its holdings of U.S. Treasury. These are assets for the Federal Reserve. Why? Because it's money that private banks owe the Fed, right? These are loans that the Fed has made to private commercial banks through the discount window. What else is on the Fed's asset side of its balance sheet? I want to emphasize some of these others because they've become more important in recent years. Mortgage-backed securities. You guys know what those are? What is a mortgage-backed security? Second row there. Go ahead. Yeah, so essentially the way they work is that an investor that wants to create a mortgage-backed security will purchase a bunch of commercial as well as residential loans, right? And they'll combine them all into one asset. And then they can turn around and sell off that asset to another investor. The returns to that asset are backed by the underlying values of the mortgages. And as people pay off the principal and interest, the owner of the mortgage-backed security gets a positive return to that. Obviously, during the financial crisis, mortgage-backed securities were kind of at the heart of the problems in financial markets. Those markets froze up completely. And in order to provide liquidity to those markets, the Fed purchased literally trillions of dollars worth of mortgage-backed securities from these failing financial institutions like Lehman Brothers and Bear Stearns. The Fed currently owns about $2 trillion worth of mortgage-backed securities. It purchases these things to try to provide support to the housing market, which is a key sector in our economy. Federal agency debt. You know what that is mainly. There are two quasi-government agencies you probably have heard of, Fannie Mae and Freddie Mac. These are not fully government agencies. They're quasi-government agencies that have actually purchased a lot of these mortgage-backed securities over time. They're helpful for making mortgages available to more and more people in our economy. Well, like any other company, Fannie and Freddie issue corporate debt, corporate bonds. During the financial crisis, as Fannie Mae and Freddie Mac were becoming insolvent, the Fed purchased a lot of their own corporate bonds or agency debt. And to this day, they still own over $2 billion worth of debt from Fannie Mae and Freddie Mac. What else is on the Fed's asset side that I want to mention just briefly here? We have gold stock, gold-backed assets, foreign currency denominated assets, so things like foreign government bonds, right? The bonds issued by, let's say, Germany, England, France, etc. There are also these things called central bank liquidity swaps that are an important part of the asset side of the balance sheet. There's some close to $100 billion worth of central bank liquidity swaps. That's what that is when the Fed provides dollars mainly to foreign central banks in exchange for things like euros or other euro-backed assets. I put a couple others on here that have recently popped into the Fed's balance sheet in just very recent weeks. And you may have seen these in the news. One is the money market mutual fund liquidity facility. That's a mouthful. The other is you probably have heard of even more, the Paycheck protection program, right? These are liquidity facilities that the Fed has recently opened up to provide municipal governments, in particular, with access to credit to provide these paycheck protection programs that you've probably heard about. Also, they're supporting more liquidity in these money market mutual funds. Every time the Fed buys those assets, it's injecting liquidity into those particular markets. During this most recent recession, the Fed has taken emergency steps to purchase assets in those particular markets. And as a result, they're now appearing on the Fed's balance sheet. When I taught this class last fall, these two components didn't even exist. Total assets, by the way. So when you hear about people talking about the size of the Fed's balance sheet, that's this number down here. That's about $7 trillion. And it's gone from about 4 trillion to 7 trillion in just the last year or two. So the size of the Fed's balance sheet keeps getting bigger and bigger. It is now, GDP in the US is what, 22, 23 trillion a year. So the total size of the Fed's balance sheet is already a significant fraction of total GDP. It's larger than many countries' gross domestic product. What about the liabilities side of the balance sheet? So assets are the things that the Fed owns, right? Liabilities are essentially the debts of the Federal Reserve, what it owes other outside parties, okay? The two most important components of the liabilities side of the Fed's balance sheet are currency in circulation and reserve balances at banks. Now, reserve balances at banks, in what sense is that a liability for the Fed? Let me make sure we have that clear in understanding right now. In what way are the reserve balances held by private banks a liability for the Federal Reserve? Well, it's the same reason why your checking account balances are liabilities for your banks. That's what is owed to you, right? So private banks, if they hold anything in reserve at the Fed, can demand those assets at any time, right? And the Fed has to be able to provide dollars to those banks to match those reserves. So reserve balances at banks are going to be a liability for the Federal Reserve. These are kind of like checking account balances for banks held at the Federal Reserve. Those are, what, close to $3 trillion. Currency in circulation. Now that's strange. Why? In what sense would currency in circulation be a liability for the Fed? How does the Fed owe anybody anything for currency in circulation? Yeah. Yeah, I think the best way to think about this is that it's kind of an artifact of when we were on the gold standard, right? At one time, you actually could take a Federal Reserve note to a bank, to a Federal Reserve bank, and exchange it for a fixed amount of gold, right? But in a more real sense, what does a Federal Reserve note represent? What's your name? Levi? When you hold if you were to give me, let's say, a $10 bill for this piece of paper, what does that $10 bill represent? To me, what it represents is a claim to $10 worth of consumption of something at some point in the future. And so in that sense, the currency is a liability for the Fed because that piece of paper is supposed to have value over real goods and services in the future. Now, you can no longer go to the Fed and convert dollars into gold. However, the only thing you can convert Federal Reserve notes into are other Federal Reserve notes, right? I can take a $100 bill to a Federal Reserve Bank, and it's an IOU, and they can give me 250s or 520s, all right? But I think the better way to think about it is it's a liability for the Fed because it's the sense in which the Fed is responsible for maintaining the value of that currency, because what I'm doing is I'm essentially giving you this piece of paper, Levi, for the right for me to consume $10 worth of goods and services tomorrow, next month, next year. So currency in circulation and reserve balances are the two main Federal Reserve liabilities. There are a few others I want to point out that we're going to come back to later in the semester. One are Treasury deposits. The Fed is the bank for the U.S. Treasury. When you guys pay your taxes, when companies pay their corporate income taxes, it goes into the Treasury's bank account held by the Federal Reserve. That totals about $1.7 trillion. Foreign governments and international organizations like the IMF, for example, have deposit accounts with the Fed. That's a liability for the Fed then. Other liabilities and capital. What's this here? Liabilities and capital. Let me just to be clear, this $303 billion includes a bunch of other Fed liabilities plus their capital. Those are the profits that the Fed makes on the interest and sale of their securities every year. Why is that a liability? Who do they have to give those profits to, Jameson? They get dumped right back here into the Treasury, right? At the end of every year, the Fed owes all of those extra profits back to the Treasury. So that's the sense in which it's a liability. One last one I want to comment on briefly. Reverse repurchase agreements. I know all this stuff sounds very technical, and it is, but I assure you, all of this stuff is going to come back into play when we look at different models of monetary policy throughout the semester. What is a reverse repurchase agreement, and why is it a Fed liability? A reverse repurchase agreement is an arrangement by the Fed with a private commercial bank whereby the Fed is going to sell one of its U.S. Treasury bonds, typically, to a private bank. But it's going to promise to buy back that security, that asset, at some future date at a fixed price, right? Let's say I'm the Fed and Levi is a bank. I'm going to sell him a $1,000 Treasury bond today, but I'm going to promise to buy that same bond back from Levi tomorrow for $1,010, which would effectively be a 1% interest rate. That's a reverse repurchase agreement, or what's called a reverse repo. It's one of the key ways in which the Fed controls the monetary base these days, okay? And that's the sense in which it's a liability, because the Fed is making a promise to buy back that asset at some point in the future, and thereby provide money to the bank at some future date. Yeah, sorry. Yes, yeah. Basically what it is the Fed is temporarily draining reserves from the banking system, kind of taking a loan from banks, and they're going to pay that back with a little bit of interest the next day. They do that to try to control the amount of reserves that are in the banking system, which affects the monetary base and therefore affects the money supply. Okay, do you guys have any other questions about this? So as we move forward here and we talk about the Fed's balance sheet and about how their actions change the balance sheet, we're going to focus on these 4 entries. So I want you to be familiar with all of these. In particular, if I were to tell you, is a Treasury deposit a liability or an asset, you should be able to place it properly on the Fed's balance sheet, right? Is a central bank liquidity swap an asset or a liability? You should know that it's an asset. But in the model of the money supply we're going to develop here, these 4 entries are actually the most important. Treasury holdings of the Fed, discount loans, reserve balances of banks, as well as currency in circulation. Okay, any questions so far? Yeah, go ahead. Very good question. It buys them, it almost never buys them from Treasury directly. It buys them in secondary markets. I think they're allowed to, but they don't do that. Because think about the implications of that. That would essentially mean that the Federal Reserve doesn't have independence from the Treasury Department, right? In that case, the Treasury could say, we want to borrow an infinite amount of money. Hey, Jerome Powell and the Fed, can you go ahead and buy up all this debt? That's effectively monetizing the debt. What the Fed does instead is it buys existing Treasury bonds from the private sector, from what are called primary securities dealers. That's a fancy way of saying the big banks, Bank of America, JP Morgan, Goldman Sachs, et cetera. There's 20 or 25 primary securities dealers that engage with the Fed on a regular basis. And that's who they buy and sell U.S. Treasuries from. Those secondary market actions affect interest rates in those markets and affect reserve balances within the banking system. But they don't deal directly with Treasury in that regard. However, Treasury Department does dump their assets into the Fed. The Fed holds Treasury deposits as a liability. I'm not going to dodge your question. I'm going to answer it in just a minute. Or it might be the next class, but I'm going to get to it. Okay, just a couple of other quick definitions before we get to some examples here. So the monetary base, what is the definition of the monetary base? This is essentially the Fed's two main liabilities on its balance sheet. It's the sum of currency in circulation plus reserve balances held by the banking system at the Fed. Now, I say this because there's a slight difference in these definitions of the money supply. I want to be clear about this. So currency in circulation, which is part of the monetary base, is slightly different than this concept called the currency component of M1. Currency in circulation, what that refers to is essentially all of these dollar bills that are circulating in the economy outside of the Federal Reserve. Well, they can be in one of two places. They can either be in the pockets of private citizens, or they can be in the vault of private banks. So currency in circulation is really the sum of the currency component of M1 plus what we call vault cash, okay? There's a difference between the currency component of M1 and currency in circulation. I don't say this to try to confuse you, all right? The currency in M1 is just supposed to be those dollars that are readily usable by the private sector to buy goods and services with. All the cash that's piling up in bank vaults is not readily usable to buy goods and services with. So it's not actually part of M1, all right? So currency in M1 is currency in circulation, which includes vault cash, and then you have to subtract out the vault cash from it. What are bank reserves? This is the other component of the monetary base. Bank reserves in general are comprised of two things. It's the reserve balances that banks hold with the Federal Reserve. This is just notes on an electronic ledger, essentially held, administered by the Fed, plus any vault cash. Banks can elect to hold some of their reserves simply as cash in the vault. Now, the vast majority of bank reserves are in the form of reserve balances at the Fed. Only a small portion of bank reserves are actually held in the form of vault cash. So actually, there's two ways to define the monetary base. I don't want, as you guys are reading the outside material and we're going through this stuff in class, I don't want you to get confused about these concepts. The monetary base can be thought of in one of two ways. It can be the sum of currency in circulation plus reserve balances at banks, or alternatively, if we include vault cash with reserve balances, then what is the monetary base equal to? It's just the currency component of M1 plus total bank reserves, which would include all of this vault cash. For the purposes of our model and the exercises that we're going to do, it's good enough to understand the monetary base as basically being currency in circulation plus the reserve balances of the banking system that they hold on their accounts with the Federal Reserve. And again, I think I actually answered this question earlier, right? These reserve deposits held at the Fed are an asset for banks, but they're a liability for the Fed, right? These are assets that the Fed has to be able to provide banks on demand. Very much like your checking account balances are assets for you, but they're liabilities for the bank. A couple of other last terms that I want to mention before we start working through the model. There is a technical difference between required and excess reserves. Total bank reserves is the sum of required reserves plus excess reserves. For a long time, the Fed required private commercial banks to hold some of their deposits in the form of reserves. Anything above those reserve requirements was considered excess reserves. So total bank reserves is required reserves, RR, plus excess reserves, which I'll call ER. The required reserve ratio would then just be the percentage of checkable deposits that the Fed regulates banks must hold. In other words, it's required reserves divided by the total amount of deposits. There was a question in the back of the room. Yes. Yeah. Okay. I think I understand your question. So the Fed recently changed their regulations on required reserves. They are effectively zero. So in today's world, in the United States, RR is basically equal to zero. And any reserve, which means that all the reserves that banks hold are of the form excess reserve. The model that I'm going to present over the next couple of days keeps required reserves in it, but we can think about what's going on today as a special case of that, where required reserves are basically equal to zero and all reserves are excess reserves. Okay, I know that's a lot of terminology. So let's go ahead now and see how in the last 15 or 20 minutes of class today, let's try to go through a couple of exercises to show how changes in the Fed's balance sheet impact the monetary base. It's a really important concept to understand, all right? The Fed historically has been able to change the monetary base by taking actions that affect its balance sheet in one of two ways. And we'll go through both of these as examples. One is through what's called an open market operation, and the other is through discount lending to banks. Now, who can tell me what an open market operation is? Surely that's something that was taught to you in principles or intermediate macro. What is a Federal Reserve open market operation? A key monetary policy action. Yeah, front row. That's right. So an open market operation is essentially when the Federal Reserve, specifically the trading desk at the New York Fed, either purchases or sells assets or securities off of or to its balance sheet, usually U.S. Treasury Securities. Whenever it makes a purchase or a sale, it's engaged in an open market operation. Those open market operations turn out to affect the Fed's balance sheet and therefore alter the monetary base. Same with discount window lending. Okay, now How does it do that? I think the easiest way to discuss this is through a specific example. Instead of talking about this in the abstract, what I want to do is show you how an open market operation of a particular amount affects the monetary base. So let's work through an example together. Let's suppose that the Fed announces that they're going to purchase $1 million worth of Treasury securities from Bank of America. So it's going to conduct an open market purchase of U.S. Treasury bills from a private bank. What I want to do is illustrate how that affects the Fed's balance sheet by using this device called a T account. Hopefully you've seen these before. What is a T account? This is pretty straightforward. A T account is going to be a stripped down version of a balance sheet, which basically shows us, it's a device that we use to show how a particular transaction changes the balance sheet. Okay, so for example, here is the T account for the banking system, the private banking system overall. Now this example is just with a transaction between the Fed and Bank of America. But we're going to just assume, for the sake of argument here, that Bank of America represents the whole private banking system. We have the banking system's assets and liabilities on this T account. What are the private bank's main assets here? It's reserve balances that it holds with the Fed, right? Also, any securities that banks might hold. Private banks hold lots of security. They purchase lots of bonds. They also issue loans to private investors. Those are all assets for a private bank like Bank of America. What are the banking system's main liabilities? Checkable deposits. That's what it owes you guys, right? The total value of those checkable deposits must be provided to its customers on demand. So that's a liability for the banking system. Also, any discount loans that banks have taken from the Fed. That's what they owe the Fed at some future date when the discount loan matures. So that's what the T account for the banking system looks like. What about the Federal Reserve? Well, we're going to strip the balance sheet down to look at just these main entries here. On the asset side of the Fed's balance sheet, we have its securities holdings and any discount loans it's made to banks. And the two main liabilities are reserve balances and currency in circulation. Okay, now somebody asked me a few minutes ago, how does this open market operation actually work in practice? So let's talk about that. How does this work? The Fed buys $1 million worth of Treasury bills from Bank of America. Ownership of those Treasury bills is transferred electronically from Bank of America to the Federal Reserve, right? So how does it, let's start with the banking system. How does it affect the banking system's balance sheet then? Ask yourself what happens to its assets versus its liabilities, keeping in mind that balance sheets have to balance. The net changes in one column need to equal the net changes in the other. If Bank of America is selling Treasury bills to the Fed, what's happening to the securities then on the asset side of its balance sheet? They are going down, right? Is it receiving something in return for that? Sure, right? Now, to answer, I think this was your question, does the Fed literally take a sack of cash and give it to Bank of America? No, right? It's much more efficient than that. What the Fed does is they credit the reserve account that Bank of America has with the Fed. They just make an electronic entry on that ledger. And so now Bank of America's reserve balances go up by $1 million. They have $1 million of new credit, but their holdings of Treasury securities decline by $1 million. And it happens instantly. What is the net effect then on the assets in the banking system? Zero, right? And so what happens to Bank of America's liabilities? Nothing, right? Balance sheets balance. There's no net changes in assets, therefore no net changes in liabilities. Okay, let's take this one step further. How does this transaction show up on the Fed's balance sheet? Fed buys the securities from Bank of America. So what happens over here on the asset side of the balance sheet? Their holdings of Treasury securities go up by $1 million, right? How does the Fed pay for those securities? By crediting the reserve account of Bank of America that it holds with the Fed. Therefore, the Fed has instantly created $1 million worth of new liabilities for itself by instantly creating $1 million worth of new reserve balances. So what's happened here then? This open market purchase by the Fed of $1 million worth of Treasury securities has done what to the monetary base? What is the monetary base? It's the sum of reserve balances and currency in circulation. It's the two main Fed liabilities. So when the Fed buys an asset from the private sector, like a Treasury security from a bank, it increases the monetary base dollar for dollar, right? So the Fed can kind of perfectly control then what's happening to the monetary base by conducting these open market operations. What if the Fed wanted to reduce the monetary base by $1 million, let's say? It does the exact opposite, right? Instead, the Fed will sell one of its Treasury securities to Bank of America for $1 million. And so the Fed's securities holdings will fall by $1 million. But what does the Fed get in return for that sale? They get to banks have to draw down their reserve balances that they hold at the Fed. And so the Fed now has $1 million less of a liability because banks' reserve balances have declined. Okay? So what we see here is that the monetary base, this is kind of the big result, will increase or decrease dollar for dollar with an open market purchase or a sale. If the Fed wants to expand the monetary base by $100 billion, all it has to do is sell $100 billion worth of Treasury securities into the private sector. If it wants to shrink the monetary base by $100 billion, it does the exact opposite. I'm sorry, it's the opposite of what I just said. The Fed buys Treasury securities to expand the monetary base. It sells Treasury securities to shrink the monetary base. Question on the back row? Yes. Yes. So there, like I said earlier, there's about 20 to 25 of these primary dealers. And that is, being a primary dealer, which gives you exclusive access to the Federal Reserve in these transactions, is a really prestigious position to hold within our financial system. As an agreement to be a primary dealer, these big banks they stand ready to transact with the Fed on a daily basis. Now, that doesn't mean that Bank of America has to sell their assets at a ridiculously low price. They're going to be at market. They're going to be at regular market prices, but they're expected to make bids and transact with the Federal Reserve day to day. So that market is deep enough. The Fed never has to worry that there's not going to be someone there to transact with. Okay. As we're going to see later in this section, the behavior of banks as well as the non-bank public is going to have a big influence on the total money supply process. But it turns out that the decisions we make about how to allocate our money between currency and checkable deposits, or how banks decide how much to loan versus how much to keep in reserve, that actually doesn't have a huge impact on the monetary base. It can affect the money supply, but it doesn't affect the Fed's ability to control the monetary base too much. In the last few minutes of class, I want to go through a numerical example that illustrates this point. Let's start from our previous example and add one additional element to it. Let's assume that now households and firms suddenly decide to withdraw $1 million from their checking account balances. Is that going to affect the Fed's ability to increase the monetary base by $1 million here? Well, let's analyze this carefully using T accounts. But now we want to think about not just the T accounts of the banking system and the Federal Reserve, but also what happens to the balance sheets of the non-bank public. Well, what are the assets of the non-bank public? Our checkable deposits, that's an asset, plus any currency we have. What are our main liabilities? Any loans we've taken out from the banking system. Okay, let's go through this step by step. We've all, perhaps, let's assume that we all think that the banking system is under threat. And so we decide to withdraw $1 million from our checking account collectively. And we want to convert those checking account deposits into currency. What happens to the balance sheet of the non-bank public? Well, our checkable deposits are going to decline by $1 million, right? But we're going to have $1 million more now in actual currency. And so what is the net effect on assets for the non-bank public? Is zero. There's no change in our liabilities, and so the balance sheet balances here. How does that action, that withdrawal of $1 million from our checking account balances, affect the T account or the balance sheet then of the banking system? Any guesses? Well, something's happened to checkable deposits, and so there's going to be a change in liabilities for the banking system, right? If checkable deposits have gone down by $1 million, that represents $1 million less in liabilities for the banking system. So checkable deposits go from 0 to minus $1 million. But how do banks provide that currency? They have to draw down their reserve balances that they hold at the Fed. And so the asset side of the bank's balance sheet declines by $1 million, and you have a drop in liabilities of the banking system and a corresponding drop in the asset side of the bank's financial statement or balance sheet. Okay? How does that affect the Fed's balance sheet? Well, the banking system now has $1 million less in reserve balances at the Fed. So this liability for the Federal Reserve goes down by $1 million. But what happens? There's now $1 million extra dollars worth of currency in circulation, which represents a liability for the Federal Reserve. So what's happened here? Our decision to withdraw a bunch of money from our checking accounts gets filtered through the banking system and on the Federal Reserve's balance sheet. But what is the end result on the monetary base? What's the monetary base? I keep hammering this. It's currency plus reserves. So nothing has happened to the size of the monetary base, right? The composition of the monetary base has changed from $1 billion worth of reserves to now, or I'm sorry, $1 million worth of reserves to now $1 million worth of currency. But the point here is that nothing has happened to the size of the monetary base. So our decisions about how much to hold in our checkable deposits versus currency, that portfolio decision doesn't actually affect the Fed's ability to control the monetary base. That's why back on that picture I showed you at the first part of class today, the monetary base can effectively be controlled dollar for dollar by the Federal Reserve. What the Fed can't control perfectly, however, is the broader money supply. And it's because these portfolio decisions affect the money multiplier, but not the monetary base. Okay, this is a good spot to stop. So here's what we're going to do in the next class. We're going to continue with this example of using the Fed's balance sheet, and we're going to look at a discount loan. how that affects the Fed's balance sheet, the banking system's balance sheet, and therefore the monetary base. We will have enough time then to move into like the second step of this story, and that is we'll start to look at this process of multiple deposit expansion and contraction to see how changes in the monetary base can ultimately impact larger changes in the money supply. But that's probably going to take us 2 more full classes to get through all of this material. And I promise you, we will have opportunities for you guys to work some problems together so that we can check your understanding as we move through the material. Okay? If there's no last questions, I'll see you guys next Monday. Have a good day.